Hello, my name is Randall Liss, and I'm here to talk about options with you. Actually, today I want to talk about the types of orders you use when you place a trade on the exchange. Let's break down what these order types are and the advantages and disadvantages. The first sort of order, it's called a market order. That means if you're a buyer, you want to buy it immediately at the lowest price you can. If you're a seller, you want to sell it immediately at the highest price you can. However, you don't know what that price is. You're buying it at the market. The market on the screen could be 2 bid at 3, but by the time you input your order, all of a sudden it's 3.4. So you're paying 4 instead of 3. You don't control the price you trade at. However, you are instantly filled. The other sort is to use a limit order. That means if you want to buy it at 3, you put in a limit bid of 3. You will not pay anything more than 3. You may get filled under 3, but unlikely. But that's your limit. Now, it's a limit order. You might not get filled. It might just sit there all day long. That's the risk you take. However, I prefer trading on limit orders to market orders because I want to trade at my price, not the market's price. So be patient. Use a limit order. And if you're not filled, there's always another opportunity. Now, when it goes against you and you have a stop loss, that means, let's say you buy it at 3 with a stop at 2. If it trades at 2, all of a sudden it becomes a market sell order. That's what a stop loss is, a market sell order. It doesn't mean you get filled at 2. You can get filled anywhere. And in the flash crash, there were some real disasters when stop losses were triggered and all of a sudden the stock was sold 10, 20, even 30 points under that price that moment. And then, of course, it roared back. So if you're going to protect yourself using a stop, I prefer the stop limit. So let's say I buy something at 12 with a stop at 10. It goes to 10. Now I'm putting in a sell order, stop at sell at 10. I won't get filled at 7, won't get filled at 8, 10. The risk I run, of course, is if the market runs away from me, I might not get stopped out. Just the same, I prefer stop limit over stop loss, just like I prefer the limit order to the market order. Now, what about duration of orders? There's two sorts of orders as far as that goes. There's a day order, which is just what it says. It will stay in the order book for the duration of that day unless filled or canceled. At the end of the day, at the closing bell, the order automatically cancels itself. The other sort of order is GTC, which stands for good till canceled. This means the order will stay in the book overnight, be there the next day, and so on until either filled or canceled. For myself, I prefer day orders. I'd rather start each day fresh. Perhaps there's news in the night while the market was closed that makes my order not so attractive now. Let me rethink it. I can always put it in again. And then I also don't have to worry about forgetting it even, especially if you have multiple orders in the market. So I much prefer using a day over a good till canceled. So these are order types. Market, trade at any price. Limit, trade at your price. Stop loss, stop becomes a market order. Stop limit, stop is a limit order. Day, good for that trading session only. Good till canceled, stays there. These are your types of orders. I hope this has been helpful. My name is Randall Liss. My website is www.thelissreport.com. I write about options every business day. Thank you for your attention.